A recruiter tells you the ESOP grant in your offer is worth 25 lakh rupees. That number is almost always wrong. Most software engineers in India treat ESOPs the way they read a CTC slide. One large headline number, no questions asked. But an ESOP is not cash. It is a conditional promise spread across vesting schedules, exercise costs, 2 layers of tax, and the small problem of the company actually surviving. So today let us build a real framework. We will break a startup ESOP offer into 4 honest parts: the grant, the vesting, the exercise math, and the tax math at exit. Start with the grant itself. Imagine you are offered 10,000 options at an exercise price of 50 rupees per share. The company tells you the current fair market value is 250 rupees. The recruiter quotes that 25 lakh rupees figure. It looks clean and impressive, but every part of that number is a future maybe. 2 quick definitions before we go further. The exercise price is what you pay to convert an option into an actual share. The fair market value, or FMV, is what the company is currently valued at per share, usually fixed by a registered valuer. Now the vesting schedule. Most Indian startups use a 4-year vesting period with a 1-year cliff. That means nothing is yours for the first 12 months, and after that, vesting unlocks bit by bit. If you leave before the cliff, you usually get 0. If you leave after the cliff, you keep what has vested so far. Anything not yet vested goes back to the company. So that 25 lakh rupee headline only fully exists if you stay all 4 years. Year by year, the picture looks very different. At the end of year 1, only 6,25,000 rupees of value is unlocked at the current fair market value. After year 2 it is 12.5 lakh. After year 3, 18.75 lakh. The full 25 lakh appears only after 4 full years. And that is assuming the fair market value stays exactly where it is today. If it falls, every vested chunk gets smaller too. Now the part most offers never explain clearly. Vesting only gives you the right to buy. To actually own those shares, you have to exercise, which means paying the exercise price out of your own pocket. In our example, exercising the full 10,000 options at 50 rupees each costs you 5 lakh rupees in cash. That money has to come from somewhere, and most startups expect it within 90 days of leaving the company. So before you even talk about gains, you should ask yourself one question. Can I actually afford to exercise these options if I leave, and am I willing to put real cash on the table for shares I cannot easily sell? Now layer in the tax math, because India has a clear 2-step rule for ESOPs and most people only see step 1. Step 1 is the perquisite tax. The Income Tax Act treats the difference between fair market value at exercise and your exercise price as salary income. That difference is called the perquisite, and it is taxed at your slab rate. Step 2 is capital gains tax, which only kicks in when you actually sell the shares. The gain there is the sale price minus the fair market value on the day you exercised. So a startup ESOP can hit your wallet twice. Once when you exercise, once when you sell. If you only model one, your real take-home will surprise you in the worst way. Let us walk through a realistic exit scenario. Assume you stay 4 years, fully vest, and there is a buyback or secondary at 60,000 rupees per share, with FMV at exercise being 400 rupees per share. First, the perquisite. FMV at exercise is 400 minus exercise price of 50, that is 350 rupees per share. Across 10,000 shares, your perquisite is 35 lakh rupees. If you are in the 30% slab with cess, that perquisite alone triggers about 10,92,000 rupees in tax, which gets added to your salary TDS in the year of exercise. Then comes capital gains. You sell at 600 rupees, your cost for capital gains purposes is the 400 rupees FMV at exercise. So your gain is 200 rupees per share, 20 lakh rupees in total. For unlisted Indian shares held over 24 months, the long-term capital gains rate is 12.5% without indexation. On 20 lakh that is 2.5 lakh rupees of capital gains tax. Now put the whole journey on one screen. 60 lakh in gross sale proceeds. 5 lakh exercise cost. Roughly 11 lakh perquisite tax. 2.5 lakh capital gains tax. What lands in your bank is around 41.5 lakh rupees. That is still a great outcome. But notice how the headline 25 lakh rupee grant did not predict any of this. Real outcomes depend on what FMV does between today and exit. Now overlay the survival math. According to a Tracks in India startup report, a large majority of Indian startups shut down before delivering any liquidity event to early employees. So when you weigh an ESOP offer, you are not comparing 25 lakh rupees to a salary. You are comparing a probability-weighted future payout, after 2 taxes, to real predictable cash today. Here is a simple sanity check before you accept any startup offer. If you are taking a 6 lakh rupee per year pay cut to join, that is 24 lakh rupees of guaranteed lost salary across 4 years. The ESOP needs to deliver more than that 24 lakh rupees in real net cash, after exercise costs, after both layers of tax, and after the meaningful chance the company never exits. Compare those scenarios cleanly side by side before signing. When you go through the offer with the founder or HR, ask 5 very specific questions before signing. What is the current fair market value per share, and when was it last set? What is the exercise price? What is the vesting schedule and cliff? What is the post-exit exercise window if I leave? And does the company offer cashless exercise at a liquidity event? A vague or hand-wavy answer to any of these is itself a data point. Good companies have these numbers ready and are happy to share them. ESOPs absolutely can be life-changing. Several Indian startup exits over the last few years have created real wealth for early employees. But that is the upside scenario, not the average one. So treat your startup offer like an investment thesis. The grant is an option. The vesting is the holding period. The exercise cost is your capital. And the 2 taxes are your friction. If the math works after all of that, the offer is genuinely strong. If it works only when you ignore taxes, exercise costs, or failure rates, the offer is being sold to you, not earned. If this finally made startup ESOPs feel less like a vibe and more like a spreadsheet, subscribe to WealthCode. We break down India personal finance the way engineers actually think, with clean math and real examples. And we are working on something that could quietly change how you read every future offer letter you ever get. Hit subscribe so you do not miss it.